Our diversification strategy has delivered a growth in organic profit, with our adjusted PBT up 2% in the first half period, and that's up 3% in constant currency. And that's despite the effect of regulatory changes in two of our key markets in Germany and Japan. We've seen particularly strong growth in our Indian business, with our offshore recruitment services company delivering 30% growth in revenue, and they've just opened an office in a second location in Jaipur to deal with the ongoing demand from clients in both the US and the UK. In Latin America, we've seen some good results from our business in Chile, and that's been driven by growth in their temporary and permanent business. We see this region as having positive trends going forward, and that's why we're pleased to have been able to finalise our investment in Peru in July just gone. That will help us to strengthen our presence in this growing region, and we see good prospects going forward there. In the UK, we've seen a mix of market conditions, but we've seen particularly strong results in professional services. And that's where we'd seen a merger of our insurance brand into LMA last year. And we're pleased to see how that has progressed and seen improved results coming through from being part of that successful brand. Also, our recent investments have all performed well. If you look at Console Partners, we've seen particularly strong growth in the US market, and that's building on the strong momentum that was coming through in the second half of last year. In Wreford Aviation, we have the benefits coming through from the investments made last year in new pilot bases, and we're pleased to see in Pharmaceutical Strategies that we're building a new pipeline of clients and also building out additional service lines. So we're pleased with the progress of those recent investments. In the Middle East, we've also seen improved performances, and the business is trading in line with expectations, and that's improved following the restructuring that we've done in previous years. So we're happy that that's now been put in place. If you look at our group overall, we have a diversification across geographies, with 66% of our net fee income coming from outside the UK. That's important because it helps us to weather any challenges in certain markets, and we've had our share of those in the first half year. In Germany, we've seen the impact of previously highlighted regulatory changes. So the first of those was introduced in 2017 with new equal pay rules, and we saw the impact of that in the second half of last year with our logistics business. We've seen that continue in the first half of 2018 with their revenue dropping by 15%, but they're now moving into a favourable comparable period, and we see prospects with potential new clients coming on board as we move into the second half of the year. Within our general staffing business in Germany and Austria, we've actually seen an increase in revenue and profit, and we have good prospects going forward with that business. The other regulatory change in Germany is the 18-month rule that kicks in from October 2018. We don't expect to see a big impact from that with our business, and the main challenge we currently have is actually having a candidate shortage across our markets. The other area where we've seen regulatory changes is in Japan, where we've seen a rule apply from April and another coming into force in October, which is impacting on non-permanent workers. This has had an impact on the hiring decisions of clients, and that's led to a reduction in our revenue and profit of our key IT staffing business in Japan. We have the additional change coming through in October, and we expect the market to remain challenged across the rest of the year. But when we look at both the Japanese and the German markets, we see very positive outcomes over the medium to long term, where if you look at the demographics, if you look at the economic situation and the ongoing demand from clients, we are very positive about the prospects in these markets, and we're confident in our ability to turn our businesses back into growth mode. We've also seen a mixed position in the UK. So we talked about the improvement in professional services. We've also seen improved profits coming through in IT and in technical and industrial, but there have been declines in domestic services and marketing in particular. In domestic services, we've made some changes to improve staff productivity, and we're pleased to see that coming through as we move into the second half of the year. We're currently restructuring our marketing brand to reduce costs there. In Southeast Asia, our Munro Executive Search brand has seen a decline overall. So despite seeing good improvements in our markets in Malaysia and China, the two larger markets of Indonesia and Thailand have been down in the first half period. Our focus here is to improve our staff numbers, to grow the staff, and therefore capitalise on the opportunities we continue to see in those markets. So in summary, despite the challenges that we're faced with the regulatory changes that we knew would be coming in this first half year, we have seen an overall growth in our profit, and we're in a good position to continue growing for the future.
Our financial highlights for the half year include our net fee income, which was down 1%, but up 1% on a constant currency basis. On an underlying basis, we have delivered growth in both the Asia-Pacific region and our Americas region. However, these were offset by the UK and continental Europe. Our conversion ratio is up 0.5% on the prior year, now at 14.7%, reflecting our ongoing strong cost management. Our adjusted profit before tax and adjusted operating profit were both up 2%. On a constant currency basis, they were up 3% and 4% respectively. Our adjusted diluted EPS is down 12%. This is largely due to profit mix, and we expect the full year position to be in line with market expectations. Our adjusted net debt, which excludes cash held in respect of pilot bonds, was 19.5 million, which is lower than the 22.3 million we had at June last year and in line with December 17. Our debt to debtors ratio, which is calculated as our adjusted net debt as a percentage of our trade receivables, was 44%, which is lower than the 52% we saw at June 17. Our net finance costs remain low at 0.3 million, and we continue to have good headroom with our facilities, and we are well within our bank covenants. During the period, we spent 0.4 million acquiring our own shares for the Empresaria Employee Benefit Trust. The trust currently has over 570,000 shares, and it will use these to settle the exercise of vested share options, of which there are 2 million outstanding at the end of June. In July, we finalised our 60% investment in Grupo Solimano, a provider of outsourcing and temporary staffing solutions in Peru. Total consideration is expected to be around 2.1 million, of which 0.2 million is dependent upon 2018 results and will not get paid until 2019. We expect this investment to be earnings neutral in 2018 and enhancing in 2019. Even after this investment, we expect to see our adjusted net debt position reduced by the end of this year.
If we look at the focus for the second half of the year, it's around our strategy of developing leading brands. And to do that, it's about investing in the companies that we've got in our group. And there are two main areas that we're going to focus on as we move into the second half of the year. The first is on staff, and it's about investing in new staff, bringing them on board, and also improving their productivity going forward. If we look at our average staff numbers in the first half of the year, we had an increase of 107 against the prior year, but that was all driven from our business in India. And what we need to see and what we're targeting is to get more growth coming across the rest of the group. We're investing in improved training and to improve our productivity and effectiveness of staff. And we're also looking at opportunities to strengthen our commercial operations team. The other area of investment will be in technology, and that is looking at where new technology solutions can improve the productivity of our staff, can improve their effectiveness. We have a number of pilot projects ongoing at the moment, and as those come to fruition, we'll expect to roll those out across a number of our brands, and we're continuing to look at other solutions that could apply for our group. Cost control has always been an important part of our business, and we have seen a reduction in our costs overall, but it continues to be a balancing act between investing and making sure that we're spending the money in the right places. So what does that mean for the overall full year? Based on our trading to date and the prospects that we have, our expectation is that we'll be trading in line with market expectations at the full year. Our growth strategy is divided into two key areas. Firstly, it's organic growth, and the investments that we're making in staff and technology should help us to deliver that. We're well positioned to make improvements in our key markets of Germany and Japan, where we're facing regulatory changes, and that should deliver improved results going into the next few years. The other part of our growth strategy is external investments. We've made the investment in Peru in July, and there's a focus to integrate that in the second half of the year. But we also continue to look for other opportunities so that our growth will be delivered by a mix of both organic growth and external investments. If we look at the position of the group now, we have a strong, stable platform to grow from. Our economic conditions are generally favourable across the group, and when we look at the investments that we're making, we're confident about our prospects going forward and our ability to deliver profitable growth.